This week, Ben and I are discussing some cotton adjustments on the global stage, along with some potential for retaliation in the soybean oil market from Canada, and then looking at some other global factors that could be shaping the markets. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing well. How are you today, Will?
Oh, cannot complain after a KU beatdown. If we have any listeners in Kansas, sorry, not sorry. MIZ got the victory.
Yeah, it was exciting times. It was, they're going to play 6 games, or they've agreed to play 6 games. I believe this was the fifth out of the sixth. And
Yeah.
so, to give Kansas their credit, they did win the first four.
Yeah.
We are the reigning champions, so we'll take it.
Well, and then I think is the next game in Kansas City
Yes.
to wrap it up. Yeah, so that'll be a nice neutral site game for next season. But I really do hope the home and homes continue. I always love seeing the energy. The energy this past weekend was pretty electrifying. But Ben, speaking of electrifying, not really in the markets. It was not a big week for swings, but giving a quick price rundown here. Looking at that March corn contract up 9 cents at 441 on December 25 corn down, or excuse me, 26 corn up 7 cents at 439. Looking at January soybeans up 5 cents at 990. November soybeans down 1 cent at 1004. Soybean oil on cents per pound for March up 1.62 at 43.04. Looking at soybean meal by the short ton for March up $1.62 at 43, or excuse me, $7.80 at 295.70. That March wheat contract up 11 cents at 558. March cotton was down 1.54 cents per pound at 69.95. And then that West Texas intermediate crude oil contract was about flat at 68.13. So Ben, really not a lot of movement one way or the other very strongly. What's your read coming into this week?
Well, so this reminds me a lot of a typical December pattern. We tend to see a little bit of a strength in December as commodity markets are adjusting due to kind of a lack of production news here in the United States. We're in the prime growing season for South America, so there's some risk premium added in just due to South American weather. But broadly speaking, we're just kind of hanging around here to the end of the year. We tend to see basis levels, especially in corn consumption regions, so like prime ethanol regions or even some of those livestock feeding regions. We tend to see basis strengthen a little bit right now ahead of the holiday season because a lot of those users are trying to bid in holiday delivery. And so this is sometimes an opportunity. The challenge is the last couple of years we've seen prices kind of fall right after the turn of the year as producers start to deliver into the market, take payment on some of those transactions, those cash transactions for row crops. So this kind of just strikes me as a typical December pattern. I don't think it's going to change a lot here over the next couple of weeks, but we could see some firmness in that local basis markets.
So really, just kind of a bit of a, not a quiet point, but a bit of a slowdown in the market and maybe some adjustments after the new year coming. But Ben, looking at some of the content you've been writing and creating the last few days, a lot of cotton discussion and a lot of shifts in the global picture on cotton. So we've seen things like record planted numbers in Brazil. We've seen high yields out of China, and then we've also seen increased import demand in China. So there's a lot of moving pieces. Also, some expected increases in other markets this marketing year on potential export destinations. So Ben, with all these things kind of in play, what does that mean for U.S. producers when looking at the cotton crop that could be moved this marketing year?
Yeah, and I'm gonna try to bring in how this impacts corn as well, if I can be successful in this. But so with cotton, cotton outlook has not been overly rosy, and certainly a lot of this has been due to weak demand in the international market and weak exports of U.S. cotton. We continuously see that in export sales data. the last couple of weeks. Very similar to what we're experiencing in some of our other row crops. It's really a growth in competition from South America, primarily Brazil. And you did a good job teeing this up. I want to talk a little bit about what's happening in this market. Brazil last year in the 23-24 marketing year exceeded the U.S. in both production and exports for the first time. And that's a trend I don't think is going to stop. I think we're going to continue to see further competition in Brazil and South America, especially as they build closer relations with the Chinese. It's coming not just from an increase in yields due to moving cotton into better quality ground and higher producing regions, but it's also coming due to increased planted acreage. And so, this last year, or at least for the 24-25 marketing year, which is the marketing year we're in now, the crop that was harvested this past summer, well, in Brazil, it'll be coming, but we've seen cotton come in behind that second crop, or come in behind soybeans as a second crop. Sorry, I'm getting a little tongue-tied this morning, and I apologize for that. And so this is a direct competition with kind of the second crop corn. Now, granted, that area or that pie keeps increasing as they continue to increase that first crop soybean acres, but we've seen favorable economic conditions for producers to look at cotton as a second crop, and certainly given the currency differences, especially as the U.S. dollar continues to strengthen and the Brazilian real continues to fall, that gives a further edging or a further advantage to Brazilian producers to export into one of the largest markets in the world, both in China and then also when we think about other large cotton importers like Vietnam. I don't think this is a trend that's going to stop. I think the U.S. dollar remains strong, and I think we continue to see further competition from South America. Now, what this does, though, is this is the tie-in.
So
right?
how does it impact corn?
Yeah, so this is the tie-in to corn. We don't talk a lot about cotton. However, I do have a lot of cotton producers in Missouri. I just want to let you know that. But so when we think about that second crop corn, right, I do think that this sends another maybe potential bullish signal early this spring when we start getting second crop acreage reports out of Brazil. Maybe smaller corn acreage than expected, higher cotton acreage. Potentially continuing to shrink the global corn supplies and increase opportunities for corn prices to move higher. So that's kind of the tie-in I have here. But largely speaking, the outlook picture continues to look bearish for U.S. cotton.
Well, and Ben, just on the points you hit on the cotton market, I feel like it's going to be somewhat slow developing. Looking at how this picture could play out, looking at discussions around countries like Vietnam. And their opportunity for export, again, seeing how that plays out. It will take I think a few months to really get a better idea of where the market is moving toward. But Ben, looking elsewhere, there's been a lot of discussion and I guess meetings between President-elect Donald Trump and looking at Trudeau in Canada. Some potential tariff fights between the two neighboring countries here. Even some jokes, seen on social media about Canada becoming the 51st U.S. state. So Ben, looking forward at the, I guess, trade relationships with an ag between Canada and the U.S. The U.S. has looked at maybe imposing 25% tariffs on certain goods. Canada has said it might want to retaliate with its own tariffs. How does this impact ag producers, specifically within the soybean front, that could be caught in that crossfire?
Sure. So let's step back. Let's go back to 2018 here for just a second. So in 2018, the U.S. and the administration placed tariffs on Canada steel and aluminum. The Canadian government responded with tariffs on Harley Davidson motorcycles and bourbon, and were very specific tariffs on certain areas of the country, and as a result, the U.S. kind of backed away a little bit from their position. Right, this go around, we've seen some interesting dynamics. It was announced 2 weeks ago that President Trump was considering tariffs on Mexico and Canada. It led to President Trudeau, or the Prime Minister of Canada, flying to Mar-a-Lago in Florida to meet with President Trump, and there was large expectations that they could work out a deal. Here at Monday this week's So just, we're recording on Tuesday. Just yesterday, Trudeau announced that if the U.S. put tariffs on Canadian goods, they would respond with tariffs of their own. And so I think what we're seeing right now is a lot of positioning with really a month and a half to go before a little over a month before President-elect Trump takes office. So I think there is some positioning that is happening. Now, to your specific question as to how this impacts ag markets, for corn, soybeans, we don't really do a whole lot of trade in bulk commodities, or at least in the dry goods with Canada. But there are two markets that impact us that I think are important to watch. Ethanol, corn-based ethanol, or just ethanol in general. Canada is our largest market. They represent just under half of all the ethanol we export. They are a big partner for us in that space. That's been a big reason why ethanol production has been as high as it is because the export portfolio has been relatively strong. So I think ethanol is a potential target for Canadian tariffs. The other one is on the soybean oil market, and Canada represents our largest international export market for soybean oil. Now, the last couple of years, we haven't been exporting a lot of soybean oil because we've been using a lot of it domestically for renewable fuel production. But certainly, I think as we look ahead, and we try to find homes for all this soybean oil that we're crushing right now, the international market is going to be a big driver for that. And we've had a very, very robust export year already for soybean oil. Soybean oil is up 56% above the season average pace currently. And if you put this into a percentage term, the export commitments for our current marketing year are 1,383% higher than they were this time last year. So, and Canada is a big reason for that. Not the only reason, but a big reason for that. So, two markets that I think are potentially I don't want to call in the crosshairs, but two markets that I think would be worth watching.
Vulnerable. Yeah.
Yeah. Now, all that being said, I just talked for a long time, and I do apologize that was a long-winded answer. I'll go back to what I said at the very beginning of this. I do think there is some positioning that is happening with 5 weeks to go. And so I don't think we've seen the end of this, and I think more will come out in the weeks ahead. And that's partially why I don't think the commodity markets have reacted to this news all that much.
And Ben, touching on one of the things you said, that even, looking at the issue here, even if there are duties placed on soybean products, soybean oil and things like that, of that nature, it could shift and make, energy production using ag goods a little bit cheaper, maybe open some other doors moving forward and maybe increase domestic use. As you did say, looking at soybean oil, it is primarily a domestic use product. So looking at that vast increase in percentage, it's kind of a small number that's easy to increase, or seemingly easier to increase. So that percentage might be a little bit not misleading, but not as hard to increase it as it might sound.
That's true. So that is true. We are starting from a small number, but I don't want to overshadow what has happened in the soybean oil export market. I mean, this has been very incredible. In fact, right now we're above the 5-year average range, right? So take away the last couple of years where we had large domestic consumption, and you go back to prime export years, and we're still outperforming those. So it's been impressive what's happened in the soybean oil market.
Well, Ben, moving forward, what should farmers and ranchers be paying attention to this week that could be moving the market?
Yeah, so we didn't get to our economic talks or notes today, but we got an employment report last week for the month of November that was much improved from October, at least in terms of job creation, and so that kind of put the focus back on a little bit on the inflation side of the equation here. And we get two big inflation reports this week. The consumer price index comes out Wednesday. The producer price index comes out on Thursday morning. Both of those will be very highly watched by Federal Reserve members as they get ready for the December meeting, not this week, but next week. And the expectation right now is a 25 basis point cut here in December. If we see hotter than expected inflation numbers, I think I would expect to see those odds of a rate cut diminish pretty quickly. So, still a lot of uncertainty in the macro economy, but one thing I'm watching very closely this week and how it impacts the broader economy, including our grains and oil seeds, is these inflation numbers. So that's the big thing. And then next Monday, we get an updated for November crush with the oil seed processors soybean crush report. So those are kind of the two big things. And of course, we're recording this Tuesday morning. WASDE will come out today. So we didn't spend a lot of time talking on WASDE, but the December WASDE report is traditionally not a whole lot of changes, just because we're kind of in this in-between season.
We're salivating and waiting for the January one.
That's right.
All right, Ben, it's always a pleasure having your knowledge and information on the program. Viewers and listeners, if you'd like to learn more about us and what we do, you can check us out at at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.